Talk Money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. As markets turn volatile and investors see their first significant drawdown since the COVID pandemic, today on the show, we talk about how you should look at judging your mutual fund portfolio, how you should ensure that it remains in sync with your goals, and whether you should be taking any sort of calls in terms of any changes. So how do you do a healthy review of the portfolio and keep your eye on your goals? To discuss this very interesting subject, we have with us Mr. D.P. Singh, Deputy Managing Director and Joint CEO at SBI Mutual Fund. And also we have with us Feroze Azeez, Deputy CEO at Anand Rathi Private Wealth. Thank you, gentlemen, so much for joining in. I must say that the market volatility is a mere coincidence. When we were thinking about the concept of this show, it was not at all linked to the current market fall. But in general, I think while we pay a lot of attention to what to buy, we don't discuss how to manage our investments and our money. So those are, some of the opening thoughts. And thank you very much for joining us on the show today.
Thank you.
Thank you, Surabhi.
So, DP sir, let's start with you. They say it's a bit of an art, it's a bit of a science, wealth management, money management, and even your portfolio management. What are your thoughts on the subject?
I think, see, as you said, this is absolutely a coincidence that market is volatile at this point of time. But the thing is, this is going to be an integral part of the market. This was supposed to be there, which was not coming for a long time. But the best thing about Indian investor is that the majority of the money is coming through SIPs. Yeah. So that is serving them, that is saving them a lot because they have entered at every level. So they are not burning their fingers at this point of time. The way it would have been had every point of money would have come through lump sum investments. So that is one of the best things. That is number one. And number two, when we look at the flows, overall flows, and the whole industry growth which we are looking at, this is majorly because of the mark-to-market gains which we had. Right. So we had a wonderful gain period, and it has come down. There's a drawdown. But one best thing in the whole story is that mutual fund industry per se will definitely come out to be winners.
Oh,
because the eye on quality, eye on other things. But see, when markets will fall down, every scheme will, the NAV will come down. Yeah. And this has to happen because the fortunes of a scheme cannot be different from the market. But when the recovery happens, the mutual fund will have a very, very sharp recovery than the market, because we have seen in the past also where the quality bias is not there, where the investments have been made without any research, without any quality check, without any management check, there people burn their fingers.
No, absolutely.
This time, I don't think for the last 2 years that people have gone into that category, whole hog. So good thing is there, and we are hope whatever has happened in the market, whenever the market recovers, maybe another 4-5% from here downward, but then the recovery is going to be the same way. It's going to be a sharp recovery.
So, Mr. Singh, let me ask you one more thing. The mutual fund data came in just a day back, right? Yeah. And even in a falling market, equity funds have pulled in more than 41,000 crore rupees. The SIP, at least the gross number, SIP number is still running at 25,000 crores, an all-time high levels. Yeah. So what has changed? What is leading to this different investor behavior, and what are you seeing in the funds?
No. See, one with the earlier used to be whenever market used to fall, people used to redeem. Now it's different. A mature behavior, when there's a fall in the market, people put in more money. Yeah. Because they want to average out whatever they have put in. And this is a mature behavior. That's why this is a golden rule which have been getting known from beginning, that buy at low and sell at high. Right. Rather than the other way. The behavior used to be different. Yeah. Today it is the way it should be. So that's something. But we look at it, 25,000, 26,000 crore coming through this SIP route. Then another, say 7 to 8,000 from the institutional buyer, which is a structural money, including EPF, etc. If you put together, the whole industry has got not more than 8-9,000 crores. And with such a huge country, 8-9,000 crores is not a big amount.
Sure. All right. Feroze, before we get to the topic at hand, your thoughts, since we're discussing the current market volatility, how is this patch of a correction and investor behavior in this correction different from maybe what you saw 3-4 years ago?
I think, hi Surabhi, I think firstly, we discussed a few things. I was very intrigued by what Sir was also saying. One, we spoke of the fall. Yeah. There are two kinds of falls. Falls which are business usual business as usual, and the second nature of equity. See, 10% fall in the last 24 years of this century has happened every 10 months. Okay, so 10% fall pe surprise hona is surprising to me. Why should somebody be surprised on a 10% correction when that's the second nature of the beast?
Sure.
That's point one. What an investor needs to be worried about is catastrophic falls. 20, 25%.
Yeah.
If I put my money and see it down by 8, 10%, that was something which was known to me before I invest.
Because that's the nature of equity.
Correct.
Yeah.
If you consider it as an art, it might come as a surprise to you. If you consider it as a science, then you would have seen the data.
Now let's talk about the need to sort of nurture our funds and our investments, right? And to give it the constant attention, time, without being too fidgety all over the place. So first step is, a lot of investors simply will go back on the internet, they'll look at a fund and they'll look at the past returns. That's your first port of call. I want to ask you why that's not the most holistic or the best approach when you want to decide whether or not to invest. Sir?
So the first thing is that this way of looking at past 1 year, past 3 year return is definitely not the best way of putting money in these stocks, because you have to be, you should be weighing the philosophy of the fund, the credibility of the fund house, the credibility of the distributors who is doing a deep research on the portfolio. Today, if I go to say Feroze to sell that why don't you look at my this A or B or C fund, he doesn't ask me what was the last 3 year return.
Yeah.
He will ask me what is the future lying in this fund.
Yeah.
Okay, if the future, I am able to convince him about the future, about the research, about the work I have done for the future next 3 years, that is the way it is. But unfortunately, that is not something which is on the public domain.
Yeah.
Public domain is 1 year, 3 year, every person who is do-it-yourself kind of person, he will look at that only and put his money. So if you ask me if I'll do that, I will never do that.
Yeah.
I will do for my money, I will see how the fund is positioned for the coming 3 years, coming 5 years, coming 2 years, how his economy is for the next 3-5 years. That is something which we have to do it gently, because this is the regulator mandated way of publication of the returns, etc.
Correct. Correct.
Okay, and second part, looking at this, if in 1 year some fund has not beaten the benchmark, it is generally being perceived as the underperforming the benchmark. And things don't happen the way you want it to happen.
Yeah.
If I am thinking of that market will fall down, it will not happen if I have thought today and tomorrow it will fall down. It may take 1 year to fall down. It will drawdown may happen 1 year down the line.
Sure.
And I was prepared for it 1 year. So my returns will be lesser than the market for that 1 year period.
Yeah. Yeah.
So the credibility, long-term database that how the things happen, how the drawdown happen, are going to be the guiding points, not the 1 year, 3 year return, previous returns.
That was such a great example and simple example that you gave us, that when a large AMC like SBI will go to Feroze and say, Feroze, hey, look at this new fund we're launching. Why don't you take it to your investors? Feroze is not going to ask you about, past returns, even if it is an ongoing fund. So let's actually take that point to Feroze. You tell us, Feroze, while, of course, I mean, it's a matter of great expertise. Selecting a fund is not a joke. But generally, when investors engage with their advisors or with their distributors, what are the additional factors that they should be aware of, that they should consider and check before taking the investment call?
Yes, there are two parts to this answer. One, I concur with what DP sir said. If you are a viewer and if you're a client or a research, you're an investor who's a retail investor who can't afford all the research or can't afford till some time a private banker who can do the research, looking at the fund house, looking at the fund house's pedigree, looking at the fund manager's stability, looking at how he has managed several funds, how all that information is available in the public domain. The two pieces of Anand Rathi's information, unfortunately not there in the public domain, but you bring it to public domain by shows. We've done so many shows and the output of that is available to all the CNBC-TV18 viewers. One thing which I swear by, two things I swear by, is called the target NAV.
Okay.
If a stock has a target, you see so many reports, TV18 tweets about this stock.
Stock price target, 12-month forward target.
So is it not logical that if a stock can have a target, a group of stocks, which is wrapped in a mutual fund, can have a target?
Wow.
Right? I was discussing this with somebody and he said, Stocks pay every time somebody was giving a stock recommendation. I was sitting as a spectator, another distributor was talking to him. As soon as he said a stock, he asked, what is the target? Then he said a mutual fund, he didn't ask for the target. So that is where it emanated from. So target NAV tells you what potential future is there. Not that it will always transpire, but it's a good hygiene check. That's point one. Point two, we do this analysis where we find out if the fund manager was on holiday, what would be the NAV. So we built some algorithms to figure out if Vasan was on a holiday. Okay, Vasan is the CIO. Would the investors be richer or poorer?
Okay, so that's a great starting point in terms of what all you need to consider beyond just past returns when you want to make that investment decision. We'll take a break and we come back and we talk about another important subject which is not often discussed. Exiting a fund. If you're sitting on great gains, should you exit, not exit, how to exit, when to exit? We'll address that after the break.
Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week, we're talking about how to manage and nurture your mutual fund portfolio in the best possible manner. So, gentlemen, I want to come to the subject of profit booking because I think that's something that will be resonating with a lot of people right now in this kind of a market. And therefore, it's important to keep some thumb rules, house rules in mind, right? So, DP sir, what would you say? Of course, equity is long-term investment and, you ride the fruits. But now, if someone has made great gains in a fund over the last 2-3 years, they're confronted with the question, should I exit, not exit, book, keep? Because if I don't book profit now, then the fund might, lose its peak performance. So what would you advise?
See, what happens in the equity market, every day is a new day. Because we are giving NAV, your notional gain is there. And you never know what is going to happen. What is my view? Suppose I enter the market today. What I am looking at 5 years down the line? That is my question. Basically, it's reaching your goal. If your goal is very near, say in next 2 years, then definitely if you are sitting on a very handsome gain, it makes sense to at least move from the diversified equity fund to a hybrid fund. So that you don't miss out on the equities
on the gain that
100%. But you shift your risk from 100% to say, if you are little more, move to 65%, that aggressive hybrid, or move to at least multi-asset allocation fund to be there, so that in case the market bounce back, you don't miss out the whole opportunity. You at least gain on something. But if your goal is say 6 months to 1 year, definitely it makes sense to withdraw immediately.
To withdraw, book the
profit and be in arbitrage,
in a liquid fund or
arbitrage fund kind of time or liquid fund. So it depends upon my need. If I need it, do it today. If you are sitting on gains, do it today. But otherwise, if it's still long term, I put in 5 years ago for 5-year period, but still I have got another 5 years. Because things change, circumstances change. I should not be worried. I should keep on sitting in where we are sitting. Because the volatility is part and parcel. So it's more volatile because the volatility has come after a long period. We saw almost 8 to 10 years of bull market. So the bear market could be little more deeper, but you never know. There's a market. Market is of two thought processes, right? Somebody is buying, somebody is selling. Even today, when people are taking the money out, they are having opportunity somewhere else. They are thinking that opportunity is there. Maybe 3 months down the line, they say, no, that opportunity is there. They will come back in hordes. And one thing is very good for us, that Indian economy, the macros are absolutely intact. And ours is the only market where people will come when they come. If you book everything today, you can miss out on the opportunity.
Absolutely, but I completely get the logic that if your goal is 2 years away, then shift to maybe a hybrid or a slightly lower risk profile fund. If you need the money in the next 6 months, then you book now. Do you concur, Feroze?
Absolutely concur. And like DP sir said, there are two kinds of investors. One who need the money in the next 3-4 years. Some people have eternal money or 5 years, 10 years from now. So I completely concur on the first category. The second category, which is if I don't need the money, is there some profit booking required? Unfortunately, complex questions, we look for complex answers. It's a complex question, right? Abhi nikalun, kab nikalun, nikalun bhi. But I think the simple answer is rebalancing. Rebalancing is nothing but an automated process of profit booking. If you have decided 70% of your money should be in large cap and 15 in mid cap and small cap, find out whether that that equilibrium is disturbed and re-establish the equilibrium. That's rebalancing within mutual funds. Second, if your two asset classes are 80 in equity and 20 in debt, the reason why I'm giving you 80 and 20 as an asset allocation itself implies that 80 should be in equity, if it's long-term money, at least, if not more. Then if 80 has become 90 by the virtue of mark-to-market, then you bring it back to 80. So profit booking has to be substituted with rebalancing for an investor.
So your asset allocation remains in place. Got that. Okay, so now after this, we need to come to the whole portfolio construction and review part of it, right? And what we need to keep in mind. And here I think investors end up being a little confused. Now, what is the best bouquet? And let's assume we're talking about a middle-aged, medium risk profile investor who has another 10, 15 years of equity investing ahead of him or her. So for such an individual, what is the perfect bouquet, sir? I mean, hybrid, fixed income. I don't think enough thought is given to categories beyond equity at times.
Yeah. Now there you have to identify the economic condition of the individual. If somebody is having the investment amount, say of 2 crores plus, and this surplus money is not the sustenance money, then for him, they think what Feroze is saying is rebalance, keep it in equity fund. Somebody is a lower ticket size, some retiree who is having 2 crore, 1.5 crore, 2 crore, and majority of the money is in equity funds.
Yeah.
There definitely it makes sense to move towards a hybrid fund. The big ticket one can continue to be in equity, but by rebalancing from small cap to mid cap or mid cap to large cap or flexi asset, so on and so forth. Yeah. But the ticket size, what is my sustenance money, whatever I need, there are different buckets of individuals. Sure. And this is a large universe, right? For these people, it is very necessary to move from equity to multi-asset or balance advantage kind of fund, or at least put additional money, because people still are having, the surpluses are being generated on everyday basis. One is, what do I do with money which is invested? One, what do I do with money I have today? Where to invest? And where to invest, asset allocation and the hybrid is the key.
Right.
For the person who is having a particular economic class. But the rich and affluent, which are there, they need to be in any case long-term equities are there. There you can do it from less riskier from high risk kind of category. That will be my answer for the people. You have to look at your economic condition also. How much money is the sustenance money? That is to be kept aside.
Got it. Okay, so we have a couple of minutes left on the show, so we have to quickly power through. Now, Feroze, here, help us out with creating that model portfolio. And maybe, also give us some names, because I know that you have a model portfolio and there are a couple of funds there that you really like. So first, tell us, what should the construction be for this medium risk, middle-aged sort of an investor, someone in their late 30s, early 40s, and some fund examples as well, if you can. Sure.
Firstly, I think equity allocation, asset allocation for your long-term money, India is only 6.7% at an household Indian savings level. So if you want to be smarter than the rest of the race, you will have to at least have 70, 80, 90% of your long-term money in equity. I can substantiate it with a lot of data, but I'll not refrain because you gave me 2 minutes. Second, there are some AMCs, we rate AMCs because there are 5-star ratings to schemes. We have an internal model to rate AMCs. There are 3 5-star rated AMCs. Okay, 5-star based on what? That's a very long story. That's a very long answer, story. But we have rated. Okay. And if you are over concentrated on these 3, don't worry. Okay. And let me acknowledge that SBI is one of those. Sure. So sometimes people say, "Yaar, mere 80% scheme SBI ki hai ya ek specific AMC ki hai." If you are in the 5-star AMC, don't worry. Okay. If concentration risk is not so much of a risk at all, to my mind. Okay. Because like SBI will launch, or these AMCs will launch any NFO at the right time. That's one of the huge barometers. Now coming to what schemes you should look for, I'll give you in different categories. In SBI, if I have to give you one, in the SBI infrastructure, which is a thematic scheme, which viewers love to have something which is a tadka. So SBI infrastructure, very rare thematic scheme. HDFC Flexi Cap is a Flexi Cap scheme. Okay. Canara Robeco Multi Cap is a little unconventional scheme. And then on the category of small cap, Invesco Small Cap. Okay. So those are some funds and broad sort of ideas one can work with. But Feroze, one more point, and we haven't discussed it on the show enough. This whole active and passive. It's not active versus passive. We all get that.
And a lot of AMCs have been talking about the satellite and core approach that, active funds should be the bulk of your portfolio. Then you add some passives. If you could elaborate on that, because there's so many, like you said, tadka, so many index-based strategies coming, momentum, quality, this, that, whatnot, leaves you a little confused.
You see, firstly, on that reaction, the answer is different for each of us. Okay, if you have the art of picking active funds, or your distributor does, active is good for you. If he doesn't, and if you're going to forget it for 20 years, then passive is better for you.
Okay.
So that's one.
Okay.
Second, active in most categories is very good. A large cap, if you want to buy a passive, then in the large cap category you can buy. 85% of the total passive AUM of about 7 lakh crores is in Nifty and Sensex. That's the reality. There could be so many tails, such long tail with several schemes, but the AUM is not there.
Sure.
So if you want to buy one passive scheme, then choose the large cap category passive scheme.
Okay.
Third, when you buy a passive scheme, you have to check whether if you did all your transactions for the last 10 years. Today you can get your total statements from MF Central. You can download all the transactions you have ever done in life on an Excel sheet.
Okay.
Download the Nifty data and check whether you're richer or poorer by buying and selling active schemes. Like I do that for the entire company's 39,000 crores of our clients. My clients are richer by 1,923 crores for this financial year by buying and selling, not buying and selling Nifty, but buying and selling those 14 scheme model portfolio.
Okay, all right, got that. DP sir, final thoughts with you. Tips that people should keep in mind when they're doing that periodic evaluation of their mutual fund portfolio. What is it they should ask themselves or their advisor or distributor to ensure that the MF portfolio is healthy?
See, 2 or 3 things which they keep in mind. See, one, I always keep on saying for looking at the equity performance, 1 year cannot be a unit.
Okay.
It has to be 3 years as a unit, at least 3 years how much you have done, whether you have outperformed the market. And see, we have a structural issue with our index also. Today, if I have to put 100 rupees in my of my portfolio to a passive fund, which is being talked about, a large cap fund, 25 rupees are going to 2 stocks. 25 rupees are going to 2 stocks. Whether I want to take a bet on those 2 stocks or not, but this is there, this is the market rate, I have to do that.
Yeah.
So that's why I will not like to take a call on that. Make it little wider. Even if you want to do it, the passive, make it like an equal weight kind of fund, where you are putting money in every stock, or you make it BSE 100 or NSE 100.
So that diversify
a bet, and that's good enough, I think. But this depends. But as Feroze is saying, at this point of time, huge opportunities are available to generate alpha over these benchmarks in longer term. But yes, there are some smart beta products which you are talking about. Factor. So this is building up.
Okay.
And as a fund house of the country, we have to be prepared for that. So we'll create every bouquet. Whosoever wants to invest, they can do that. But on view is that still there's a lot of alpha lying in the active.
Okay, gentlemen, this was, I think, a very helpful classroom, a quick crash course in terms of managing your beautiful bouquet of mutual funds, and hopefully investors will keep a lot of this, the valuable insights in mind. Thank you for joining in, and we look forward to another conversation.
Thank you so much.
Thank you. Well, with that, we're completely out of time on this edition of Let's Talk Money. See you again next week.
Let's Talk Money